Welcome to our webinar, Understanding and Managing the Indirect Cost de Minimis Rate. This webinar is being presented by the Eastern Region Training and Technical Assistance Center, which is a resource of the Administration for Native Americans. We have a lot of information to go over today, but before we start, I would like to go over some housekeeping tips. We are recording this webinar, and it should be available on the ANA website and on our website in about 2 weeks. You should have come into this webinar muted. However, if for some reason you are not, if you could please take a second to mute yourself. We're anticipating a large number of participants on this webinar, and we want to make sure that everyone can clearly hear the presentation. We do have a number of resources available for you, including a PDF of this PowerPoint. If you go to the chat, you should find a Google Drive link that contains all those tools and documents. And we're going to be dropping that into the chat several times. So if you miss it the first time, you should be able to get it and download it later during the presentation. We do plan on having a question and answer session at the end of this webinar. As we're progressing, if you have any questions, if you could please type them into the chat, and we'll get to as many as we possibly can at the end of this presentation. And lastly, I didn't put it on the screen, but if any of you are using a phone to join this webinar, if you wouldn't mind going into and finding your name, right-clicking it, and changing your phone number to a name, we would really appreciate it. And it would help us if we're sending out any materials after this presentation next week. My name is Candy Carmi, and I'm the Deputy Director of the Eastern Region Training and Technical Assistance Center. And I'm from the Oneida Nation in Wisconsin. I've been providing technical assistance for over 16 years now. And during that time, I've worked with numerous applicants and recipients on their project budgets. Inevitably, I field questions on indirects, and especially so when I'm working with applicants who don't have a negotiated rate and they're curious about using the de minimis rate. Most of these questions I can answer. However, there's times when I get questions that stump me, and our presenter is my go-to resource for getting the answers. Susan White is here to demystify indirects and help us understand the requirements that govern their use. Susan White is a senior partner for ATCO Inc., a private Indian professional services firm, and she serves as the senior partner. She has over 40 years of experience in the field of financial management. Ms. White has worked with over 300 tribes and Indian organizations in the areas of comprehensive planning, resource development, organizational development, financial management, staff development, administrative operating policies and procedures, and economic development. We are really fortunate today to have Susan as our presenter. So our objectives today are to provide you information on indirect cost and their use within an organization. We're going to go over the federal regulations that govern indirect cost, and we're going to learn how to distinguish between direct and indirect cost. And lastly, we're going to go over the management of indirect cost. So let's begin and pose our first question to Susan. What are indirect costs? Susan?
Okay, thank you, Candy. Well, indirect costs, what they are is an expense that's used for a common purpose within your organization, and it benefits all the programs. So an example of that would be the executive director's time. You know, when they're working on policies for the whole organization, that would be indirect. All right, but if they're doing a training for, say, your A&A grant or for an education project or that, then their time could be direct charge. But they can, they are typically included as part of the indirect. Accounting, that's an easy one. When you're doing accounting, you're working for all of the different funding sources or all of the different projects within your organization. It would be very hard to break it out, how much time was spent on each. Human resources are another example. We'll go over more of these as we get into it. So those are indirect costs. Again, remember, it benefits all of the projects and all of the funding sources within your organization. Now let's take a look at direct costs. And what those are just what it says, direct costs. The project director, okay, project staff. Travel to an A&A conference would be a direct cost to A&A. Materials used for an A&A project, or maybe you have an event, a cultural event for your A&A project or one of your other projects. Those would all be direct costs. So those are the direct costs. What is the purpose of indirect? Indirect is just a way to easily and fairly proportion the administrative expenses to all the programs so that everybody's paying their fair share. All right, it's very easy if you have a lot of funding sources or multiple funding sources, where you can put those into your indirect and you're not sitting there trying to figure out how much time did I spend writing checks for this project, or how much time did I spend writing checks for this project. So it's just a very easy way. One thing I do want to say is that indirect costs can be your best friend, but it can also be your worst enemy. Let's look at it as your best friend as we go through this webinar, all right? Because it can really be. I know some people are perplexed by it, but it really does make operations much more efficient when you have a number of different revenue streams coming into your organization. What we're going to be talking about today is specifically the de minimis rate. And I have trouble pronouncing it, you guys, so bear with me on it. Okay, the de minimis rate is 10%. And this just came into play in about 2014. All right, and what an organization can do is they can choose to use the de minimis rate. And so you're allowed to use that, and it's 10%, it's capped. It's like a fixed rate. I'm not going to be talking about negotiated rates today, which is something different, although I will reference them at certain points, but we're just strictly talking about the de minimis rate. Now, there's a lot of advantages to using the de minimis rate. Okay, one is that you can start using it immediately. And for those of you that have negotiated a rate, sometimes it takes 6 to 8 months to get your rates. So that's very, very nice. The other advantage is it doesn't require the annual proposal. And those are no small deals, you guys. Doing that proposal takes a lot of time and is a lot of work every year to do it. Well worth the work, don't get me wrong, it's well worth the work, but it does take a lot of time and a lot of work. So that's another advantage to it. Now, who can use the de minimis rate? Okay. And you guys, I'm going to quote regs, so don't get scared here. Okay, in 45 CFR Part 75, it says that if you have never had a negotiated rate, you can use the de minimis rate. All right, and that is based on 2 CFR Part 200, which goes for all federal agencies but HHS. And that was what was originally established in 2014. Now in 2020, 2 CFR Part 200, so if you're getting money from, education or EPA or labor or that's what you're following. They have changed it to say if you don't have a current rate, you can apply the de minimis rate. All right, now there's certain groups that cannot use the de minimis rate. One is once your organization receives over $10 billion in direct federal funding, you do have to negotiate. And also governmentals, which means tribes, you do have to negotiate a rate. So although it has some great advantages, you know, it really does lay a lot of responsibility on you for the planning and the management of it. The planning and the management in the proposals, or the planning of it, excuse me, in the proposals are pretty much taken care of. Well, since you don't have to do a proposal, the planning is going to be your responsibility. We're going to talk about that quite a bit during this webinar. Okay, so now the de minimis rate, what it means is that you can apply it, you apply it to what's called the modified total direct costs. That's all your costs. That's salaries, that's wages, that's supplies, that's travel, all of your direct costs. Now there's certain costs that you cannot apply it to. And we're going to talk about how we pull these costs out. And one is equipment as defined, all right. Another is capital expenditures. You don't need to worry if you're A&E grantees and that's your funding source. Patient care, that's for more of the NIH grants and that. Rental costs, tuition remission, that was put in there, scholarships and fellowships for the universities, and participant support costs, I'm going to talk about that. And a portion of any subaward or contract or subcontract in excess of $25,000. So you will not be able to charge the 10% on those costs that I just said, but you will be able to charge it on all the other direct costs. So how do we come up with this? How do you, you know, how are you going to apply it? Next slide, please. Within your organization, you know, you really are going to have to take a look. And one question I get asked a lot is, does the organization have to apply the indirect cost rate to all awards or just to federal awards? No, once you make that decision to apply the de minimis rate, you have to apply it to all of your funding, all right, to all of your awards that benefit from those common activities. This is probably the #1 question that I get is, well, do we just charge it on our federal awards? No. If you have some foundation funding or some state awards, it goes across the organization. And that just makes sense because these common purpose activities that we're going to put in indirect will benefit all of your projects. So that's a consideration because I know that we have some funding sources that don't allow for indirect. All right, so you're going to have to work with that and deal with that. And there's ways to do that that we probably won't have time to talk about today, but you're going to have to come up with it some way or the other. Right, well, anybody that knows me knows that the first place I'm going to go to are to the federal regulations. All right, I always go to the regs first. Okay, what are the rules? These are the rules of the game. And indirect costs is spoken to in a number of different places. Now we're speaking to 45 CFR Part 75, which is the codification of 2 CFR Part 200 by HHS. So, I mean, you could change that 45 to a 2 and that 75 to a 200, and it'd be very close to the same. But we're talking about an HHS funded project, which is the Administration for Native Americans programs. So you'll find it in the definitions. They talk about it. There's certain things that touch on it. We'll find it in the post federal award requirements section of the regulations. We'll find it in the cost principles, and we'll also find it in one of the appendices. So let's look at each one of these separately. So the first part we're going to talk about is the definitions. All right, now, and I'm talking about all indirect. A cognizant agency, if you have the de minimis rate, you do not need to worry about your cognizant agency. Okay, your cognizant agency only comes into play when you're negotiating a rate. And tribes have to negotiate with the Interior, and then other nonprofits that are going to negotiate their cognizant agency will be whoever gives them the most money. Just keep that in the back of your head. If you're using the de minimis rate, you don't need to worry about that. Okay, they give the definition of capital expenditures. All right, remember, we can't apply our indirect towards capital expenditures. And what that is that's land, property, major renovations that add value to property, things like that. With A&A funds, you know, that's typically not the case. Equipment, we have to look at that because we can't apply it to equipment, and equipment is defined as a singular unit costing $5,000 and having more than a 1-year life. And when we say singular unit, what we're saying is whatever makes it work. Like you can't have a CPU that costs $3,000 and a monitor that costs $3,000. When you put it together to make it work, we're at $6,000. So always remember, I'm not going to be able to charge my indirect cost to that. They define an indirect cost rate proposal. Now, if you're using the de minimis rate, you do not have to worry about that at this point in time. When you're considering going for a negotiated rate, then you start worrying about that. Indirect costs, they just, what we just previously said, for a common purpose. Modified total direct costs, again, that's what we just said. We can't apply it to equipment. We can't apply it to capital expenditures. We can't apply it to participant support costs, okay? And then they define us what a sub-award is, and we might as well say contract sub-award and what am I missing here? Contract sub-award. Oh, and subcontract. Okay, so we can't apply. We can apply it on the first 25,000. We can't apply it on any amount over that. So if you have a contract for $40,000, you'll be able to apply it on the first 25. You will not be able to apply it on the next $15,000. All right, so now in the subpart D, okay, of the post-award requirements, one thing that's really, really important to remember is that the requirement for management of direct expenditures also applies to indirect expenditures. Okay, and that's trust me, you guys, I'm not going to do the regs, but just remember that the financial management standards still apply. All right, you still have to have source documentation for your indirect cost expenses, you know, just like everything else. The internal control provisions still apply. You know, we've got to have 2 people involved in every transaction. The procurement, you still have to go through your own procurement procedures with indirect expenses, such as if you're going to get an audit and you need to get cost quotes for anything over $5,000, your estimated cost for the audit is $10,000, you'll have to follow those same procedures. One thing that they also talk about is that subgrantee management. If you have a subgrantee and they want to negotiate an indirect cost rate, you as the grantee would have to do that if they don't have any federal awards. Or if you're the subgrantee and you don't have any federal awards, which I know you all do because you've got A&A funds, you know, they would have to negotiate with you, but you could always allow the de minimis rate. So that's where it's spoken to in the post-federal award requirements. Now in the cost principles, it's spoken to in a lot more detail. First of all, they talk about factors affecting allowability of costs. Well, that's really no different. They have to, you know, it's the same things. They have to be necessary and reasonable. They have to conform to any regulations or limitations. You have to have consistent treatment, and that's a big deal with indirect and direct, all right? Consistent treatment, okay? And you have to have, your policies have to be consistent. So that's kind of a big one. The next one is pretty common, reasonable costs. It has to be what a prudent person would normally do. All right, so we know that from our cost principles. Okay, they talk about classification between indirect and direct costs. And then they speak more to, again, to direct costs. What are direct costs? They speak what are indirect costs. Okay, the cost principles also talk about if you're using an indirect cost, de minimis or not, there's required certifications. And, you know, even though in a proposal, if you were negotiating, you would submit your certification, you probably just want to have a certification on file within your organization. And then also in the cost principles, we go into the selected items of cost. If it's not allowed, it's not, if it's not an allowable cost, it's not allowable cost for direct or indirect. It goes both ways on that. All right, so it covers the full spectrum. Any costs that require prior approval, they require prior approval, and I'll show you where you'll put it with your indirect, because when you, and in planning, because we don't really spell out when we our indirect costs, but we'll show you how to do it within your organization so it's clear to everyone. So the cost principles speak an awful lot about direct and indirect costs. And the last thing would be the appendices. And appendices 4, you really don't need to worry about this, you guys, because this is, you know, for when you're negotiating rates, although I think it's good reading material. And you especially need to read it if you're considering going for a negotiated rate. All right, and what they discuss in there is the simplified allocation method, which is a de minimis rate. They talk about multiple allocation method. You don't need to know about that now, okay? The direct allocation method, special indirect cost rates, don't worry about that. They do talk about the negotiation process and approval, and that's when you're negotiating a rate, and the certification of indirect costs. So don't worry about this one yet. Read it though if you're considering leaving the de minimis rate world and moving into a negotiated rate, which is a very, very serious consideration. And so these are the regulations. So at least you have a foundational information about what the regulations are and how they touch on the different aspects of indirect and direct. Okay, now let's get right into how do we do this? Okay, well, first of all, there's 2 criteria for what's going to be direct and what's going to be indirect. Okay, if it's a common purpose that touches all of your programs or your projects, indirect. If it's specific to a project, it's direct. And I already gave you the example of the executive director. They could be charging time to indirect and they could be charging time directly. So there's no right or wrong. So let's take a look at all your different costs that you might incur. Okay, and the base means what you're going to charge the indirect to. And the pool are your indirect expenses. All right, that's real important concept. So remember that the base is what you're going to charge it to, and the pool are your indirect expenses. Now, there's no set pool. There's no way to say, should this be an indirect or shouldn't it be an indirect? That's going to be on your individual organization's operations, and you're going to have to make those determinations. But I recommend you go through all of your different cost categories, you know, and take a look at, you know, is this going to be a direct expense or base, or is it going to be an indirect or pool? All right, and you can see they can go into both categories. We've used the example of salaries. Okay, same thing for fringe benefits. All right, typically those are charged in proportion to how the salaries charge. Payroll taxes, accounting, look at, typically that is an indirect expense. Advertising, oh, you guys be careful with this one, but it can go in both. Typically bank fees, you know, like the monthly service charge or something, that's an indirect. Unless you have a separate bank account for every grant that you have, which I hope you don't. Board of directors is typically indirect. Contracts, you can see all the way down the line that they could go either way. And you're going to have to decide how you do that and what's going to be in your pool or what you're going to charge to indirect and what you're going to charge as a direct charge in your base. So that's, to me, that's the first step. We take a look at what it is. The next thing that you need, well, I think is very important. I shouldn't say you have to do it, okay? But you know, what I think will really help you and is good planning is to develop a cost policy statement. And what a good cost policy statement is it includes a purpose of the statement, your general accounting policies. a description of how you're allocating your costs between direct and indirect, and then it details each of the costs. So let's look at one. Let's look at the first part of one. Okay, and we want to thank Parta E Perpetua and E Tau. They said we could share their cost policy statement with you today. So let's take a look at theirs. The purpose of the procedure is to ensure that expenditures are charged and, to indirect costs are determined fairly and consistently. We're tying into the regs there. That's a really good opening statement. And adhere to PIPED's established indirect cost elements and the cost principles. Best way to start out, hey, we're doing what we're supposed to do. Then they talk about their general accounting policies. First is their basis of accounting. They're on a modified accrual basis. You can either be on accrual, modified accrual, or a cash basis. We won't get into that now. Okay, what's their corporate fiscal year? January 1st to December 31st. Your indirect cost is based on your corporate year. Remember, your indirect cost is based on your corporate year. I'm sure you have a lot of different funding sources that start and end at different periods. But when you're looking at indirect costs, you look at it from your corporate year. Your allocation basis or your direct allocation costs. Your indirect cost rate allocation basis is modified total direct costs, because if you're using the de minimis rate, you have to use that. And then they tell them what good internal controls they have, okay, and how they accumulate their indirect cost expenses. Now this F could say revenue and expenses. They're using it based on expenses, and they're capturing the revenue through their different departments. And then it further goes on to show just what we did in our little chart when we were figuring out what to do. It shows, what's indirect and what's direct. Remember, I called the direct the base and I called the indirect the pool. So you can see, you're going to find costs, these costs in our indirect, you're going to find these costs in our direct. And then what's really good is that they really break it out. These are our direct charges, okay? The majority of the employees direct charge their salary costs because they pretty much just do projects. We have some people that have mixed charges. That means their time could either be indirect or direct. And in this case, it's their executive director and their project director. All right, and mainly because it's a small organization, there's, and in order to get internal controls, the project director has to be involved in some of the administrative activities. And so they're going to have to charge their time to indirect for that. Okay, they also tell you that they use their timesheets to document, what time is spent on indirect and what time is spent on direct. So, and then they go through and we're not going to show this to you, but they do that for fringe, for travel, for supplies, for postage, for printing, and they go through. And so everybody knows what should be charged to direct and what should be charged to indirect. I'm sure some of you out there have wondered, what do I charge this to? Or what does indirect pay for? This lets everybody know. It lets the organization has made a decision. All of the staff know what costs go where. And then also your funders know, hey, these guys really are on top of it. So this is a really, really good thing to establish right off the bat. You could also add, remember I said certifications, you may need to have one on file. You could put that on there, and I'm going to show you another planning document you may want to include with this. Now, Eastern in that Google Drive, they've provided you a template so that you can, develop your own cost policy statement. They've also provided you with a full example of PIPED's cost policy statement, so you can see what another organization has done and how they've structured theirs. Okay, I just can't stress it enough. A cost policy statement is really, really a good thing to develop within your organization. Now, how do we decide? Let's look further into planning. Okay, it's really no different than planning a project budget. You know, your indirect revenue is typically what a grant award amount would be, and your indirect expenses is typically what your expenses will be. But you do need to plan. So let's look at an example of how you can plan. All right, how you can plan all this. Let's go to the next one. I hope all of you can see this, because this is how you really, this is what you would have to do if you're doing a proposal. But take a look at what they've done here. They've got their federal programs. They've broken it out between their federal programs and their non-federal programs. They have, and these would be their direct. This would be their base, and these would be their direct expenses. We've got an A&A grant, we've got an education grant, we've got a AOA Title VI grant. And then for our non-federal programs, we have the Ford Foundation and the Mattson Foundation. So when we add all those up, you can see that we have our total direct costs. And that comes out to $796,900. So that's our total direct costs. Now our indirect costs, we've done a budget, so we plug in our budget here. And our total indirect costs are $78,910. So the agency has an organizational budget for their corporate year of $876,010. Now let's see how we stack up with a 10% indirect cost rate. Well, the first thing I'm going to have to do is take my total direct costs of $796,900. Oh, and I have modified, so I've got to take out what I can't charge indirect to, and that would be my rental. I can't charge indirect to. And I should speak to this. The reason it's called modified total direct costs is because there's certain expenses that don't require a lot of administrative or indirect resources. Like if you buy a piece of equipment, all you're doing is getting your quotations and writing one check. You know, it isn't like salary for somebody where you're doing the payroll and the payroll taxes and the fringe benefits, you know, multiple times throughout a month. So that's why they pull it out of the base. Anyway, so once I subtract out my rent, my total direct costs that I can charge my indirect to is $789,100. Well, if I divide that by my, if I divide the 78,000 of indirect by my 789,100, I come out to a perfect 10%. Okay, that doesn't happen in the real world. I'm just telling you guys that, but in my make-believe world, it happened. But if you're planning this way, you'll say, oh, we're going to have to cut back on our indirect expenses because we aren't going to have enough revenue to support it, indirect revenue to support it. Or, you know what, our plan shows that we're going to have too much revenue, and we're going to talk about this later. So it really helps to do a plan like this first. So you see, you don't just apply the de minimis rate to all of your grant awards and hope and pray everything works out in the end, although there is a lot of praying with indirect. But, you really want to plan it out and see where you're at, because again, you get to determine the pool, what you charge to indirect. Your base is set if you're using the de minimis rate to modify total direct costs, so you don't have an option there. Now, this takes a little time to do, especially since you're going to be doing it on a corporate year, and you've got all these different funding sources that are on different budget periods. So you're going to have to use your cash flow projections, which you all did on your 424s when you submitted your application, and hopefully you did a good job on them, and see where you come out. And this will give you a feel at the start of each year where you're going to be. So I think this is, again, it takes time, but the time is well spent. Just like developing your original cost policy statement, this takes time, but it's time well spent. All right, so that you know that you are, in the ballpark, or you're close. And maybe you have to make adjustments. And if you do this now, you'll set your pool, so that it captures costs in alignment with the revenue that you're generating. So I think that, before you get into start using the de minimis rate, or if you've just started using it, I just cannot, I've said it probably 5 times now, do a cost policy statement and look at it, do an analysis, of your costs to make sure that you line up what you've planned it for that indirect cost pool or expenses. Now, when you're doing your budgets for your grant projects, okay, it's pretty easy. You list all your direct costs, you subtract out, what you're not allowed to charge indirect to, which is equipment, rental costs, tuition, remission, scholarships and fellowships, participant support costs, and the portion of any subawards or contracts or subgrants over $25,000. Let me speak a minute to participant support costs. You really need to learn that definition, because a lot of people are really worried. They have a lot of participants in their projects and they're, oh no, all the costs for those participants we can't charge. There's a very specific definition for participant support costs. It means direct costs for items such as stipends or subsistence allowances, travel allowances, and registration fees paid to or on the behalf of the participants or trainees in connection with conferences or training projects. That doesn't include employees. Okay, so like if you're going to have a cultural event for the participants, it's not a participant support cost. Remember that. All right, it's a participant cultural event. When you're planning your budget, and we're going to look at a budget right now. Let's look at the budget, Candy. And see, here's a typical budget that you'll see, where you have the personnel, you have the fringe benefits. We're traveling to ANA's post-award training and to the grantee meeting, to the we've got some equipment in here and supplies, and we don't have any contractual. And you can see, so I've got my total direct costs of $240,134, right? Well, then I have to subtract out, I've got equipment costs of $35,395. So I'm going to have to subtract that out. So I'll be able to charge 10% of the $204,739, which gives me indirect of $20,474. So I hope that makes sense to everyone when you're doing it. And I make this mistake all the time, you guys, where, I'm doing a budget and I forget to subtract out the costs that I can't charge it to. And then I get a call and they say, why is that in there? And, oh, well, probably because I messed up, but that's how you plan it out. That's how you plan it out. And when I was talking about the participant support costs, okay, when you're labeling your other cost categories, think about that for a minute and think about, say, participant cultural activities or participant social activities. Make sure you make a clear distinction between a participant support cost and what you're doing with your participants. If it's not part, like if you have an apprenticeship program, yes, obviously the stipends you wouldn't be able to charge indirect costs to. So just be very, very clear when you're preparing your budgets for your different grant projects. So that's, if you do the front end planning, when you get to doing your project budgets or your program budgets, you can do them correctly. You can do them correctly. The next thing we're going to talk about, though, is managing your indirect costs. And I say that indirect costs are, you have to manage. You manage. You always look at where you're at, because remember, you don't generate indirect revenue unless you have direct expenditures. So it's not like a grant budget where there's a fixed amount. This is what's called a variable amount based on your direct expenditures. So you want to look at that every month and look at it closely and track it very, very closely. Let's go and show how you can track it, Candy. You see, this looks like your monthly expenditure reports for a project. Now this is, remember, I'm going by my corporate year, so I'm in the second month, right? And I show what my projected budget is going to be. There's my 78, 9, 10. This is all just for indirect. And then I show the indirect revenue that I have generated based on the expenditures of the different projects. And if I look at it cumulatively, I've generated $8,810 in revenue. But look how much I've spent. I've spent $15,712. Okay, if I'm looking at this closely, we can, at least every month, you can make the appropriate adjustments so that you're going to come out so that your revenue equals your expenditures at the end of the year, the end of the corporate year. So again, please, 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 if you take nothing away, manage your indirect very closely, because you want to watch it just as you would any project, if not closer, because it's a variable revenue expense. It's based on the expenditures of each one of your projects and not a fixed amount. So that's what we have. Now let me tell you what can happen. Okay, and this is me in my first 10 years of working with indirect. That's what I look like. And that's what Candy looks like every time I talk to her about indirect. There's a couple things that can happen if you don't manage it closely. One, you could have unrecovered indirect costs, or you can have over-recovered indirect costs. So let's look at unrecovered indirect costs. What that means is that your expenses exceed, your expenses are exceeding the revenue you're bringing in. And so you're in a deficit position, and that has to be corrected. And usually how that's done is you have to use unrestricted funds to cover those expenses. So let's look at an expense sheet for indirect. All right, you can see I did this at December 31st. It's the end of the corporate year. And what I have here is that my total revenue that I generated was $72,926. But my expenditures were $88,521. So I've overspent my indirect, by $15,595. If this was a profit and loss statement, you've lost money. All right. And this is what you want to, you want to be very conscious of, unless you have a lot of unrestricted funds that you can use to make up the difference, which most of us don't have. So anyway, that's what happens when you're in what's called under recovery. The second scenario that can happen is called over recovery. All right. And what happens here is that you've generated indirect revenue based on the expenses of your projects, but your revenue exceeds your expenses. And so what happens here is you've made a profit. Well, guess what, guys? We can't make profits off federal funds. So let's take a look at what happened here. We generated $67,000. And it's, again, thanks, Candy. It's December 31st, 2022, so the end of the corporate year. We've generated $67,701, but we only spent $57,988. Okay, so what happens here? Well, you don't get to keep it, you guys. You can't make a profit. So potentially what could happen is that you would have to pay back the funds to each one of the funding sources in proportion to what they, what they're owed. Like A&A's could be $631, education's could be $800, something like that. That's the potential of what could happen. There again, that's why you want to manage it so closely. Okay, because you really want to come out as close as possible to your revenues equaling your expenses. If I told you they were always going to equal it, I'd be lying to you, all right? But try and get as close as possible. It's like if you're overexpending in indirect, and your executive director is working, spending a lot of time on developing personnel policies or an IT project for the whole organization, you may have to talk about it with them and say, could we cut back and hold the rest, finish this project into next year? Those kinds of discussions need to happen for this to work. So plan, and manage, you guys. And running out of time here, so let me just summarize. First, indirect costs are for a common purpose. All right, they benefit all the programs or projects. There are federal regulations that you have to be aware of and you have to adhere to. Okay, planning, is key to indirect working for your organization, and manage your indirect revenue and expenditures as close as you would any other grant or project, if not closer. Okay, now A&E Eastern has developed, and they're on that Google Drive, a number of tools for you to use with indirect. First, for budgeting, when you're doing a project budget, how to apply the de minimis rate to it. Okay, so they have an Excel spreadsheet with instructions for you that can help walk you through it. I talked about certification of your indirect. Okay, there's a template for certification of your indirect cost rate. Nobody will probably ever ask you for it, but man, would you guys look good if you had it on file and someone actually did ask you for it. Okay, and you may want to put it into your cost policy statement. Okay, they've also given you a template that you can use to develop your cost policy statement. And because I think it really helps to look at another one, there is, Pippin's example of their cost policy statement, and we want to thank them for allowing us to use that. They also have for you a tool for monthly tracking of your indirect revenue and expenses. Okay, and it's an Excel spreadsheet. It starts in it's one file, but then each one of the worksheets, it starts in January and ends in December, but you can change it. If your corporate year starts in July and ends in September, just change the labels on it. There are formulas in a number of these cells. So if you accidentally type something in that cell, you're going to lose a formula. If you just put in the current revenue and the current expenses, you should be good. Okay, and that's very, very helpful. There's a tool for planning of your indirect costs, where the very first stage where you look at all your expenses and say, oh, this is a direct, this is an indirect, we're going to do this both indirect and indirect. And then they also have, there's also the tool, whoops, I kind of flipped on these. There's also the tool for, that spreadsheet where you list out all of your different funding sources and you add up your total direct expenses. And then you have a column for your indirect expenses. They've given you a tool to use that. So those are the two basic tools in planning. And then they also have developed a handout for you about indirect cost. And this deals with negotiated indirect costs and also incorporates the de minimis rate. So if you're thinking about going to a negotiated rate, it talks about the different types of rates. It talks about the different bases. It talks about, what needs to go into a proposal. It's short. It's kind of the severe cliff notes of indirect, but it gives you, when you're thinking about it, it just gives you additional information that you can work with. Okay. And with that, I'm going to turn it back to Candy. Thank you so much, you guys. I mean, I really do enjoy indirect, and I really appreciate it when people listen to me talk about indirect. So thank you so much for your time. And I'm going to turn it back to Candy.
Thank you, Susan. I indicated that I am with the Eastern Region Training and Technical Assistance Center. However, the Administration for Native Americans has 3 additional technical assistance centers that you can see here on your screen. And the contact information for them can be found on the bottom. If you have any questions on A&A projects or project development, please feel free to reach out to one of these regions. And I also do want to note that we did put, if you download the handout for the PowerPoint, we have Susan's contact information on one of the, I think it's the third slide. So you can find her contact information there. And maybe Kwani, you can drop that in there too, please, into the chat. So we are now at the point where we can answer any questions that you have on indirects. If you would please type them in to the chat, we will try to answer as many as possible. Kwani, do you see any questions?
Yes, we had about 6 questions so far that were entered into the chat. So the first one was, if we have a sub-awardee, can they use their indirect rate to their budgets?
Yes. Okay. Do they have, if they have a negotiated rate with the federal government, you would accept that rate? Absolutely. And if they don't have one, there's 2 options that you can negotiate one with them. Ton of work, or you can allow them to apply the de minimis. But if they've got a negotiated federal rate, the deal with that is, and this just really got clarified in 2014, is that all federal agencies and direct grantees will accept that negotiated rate from the federal government.
Okay, thank you, Susan. The second question, can unpaid sick leave and annual leave be charged to indirect cost?
Sick leave and what?
Sick leave and annual leave.
Yeah, if you put that into your cost policy statement, you can either, oh, this is for the de minimis rate. Yeah, you could put that in to your, that's where your cost policy statement is so important. You could put it into the cost policy statement, and then that's where you would always charge it.
Awesome.
Remember, consistent, be consistent, and consistently apply it each time.
Next question is, since we are not supposed to hold on to federal funds in our bank accounts longer than 72 hours, what if we have indirect funds sitting for like a month?
No, I'm not touching that one, you guys. I probably, well, okay, I will touch it. All right, I will touch it. Okay, let me tell you, I will touch it. I probably wouldn't pull them down until I actually expend them. I mean, I wouldn't probably, that's what I've done. You know, I don't pull them down. You know, I don't pull them down because when someone comes into, and for those of you that have not been audited or had a federal audit done, they'll look to check those cash balances, and if the checks aren't written, they'll see it's excess cash on hand, you know. So I wouldn't, no, just do it for your expenses, you guys. Just draw down funds for your expenses, because you're only allowed to have 3 days cash on hand. So, you know, at the end of the year, you know, you should equal out and you should be able to pull it all down. And that's where managing it is really important too. But that's a great question. That's a great question. I had to think of that one. Really made me think.
All right, next question. Can you further define what it means to treat a cost consistently, since it looks like an expense can be both direct and indirect? What does treat consistently really mean?
Okay, well, we just had a good example in a previous question. They want to charge their sick leave and their annual leave to indirect. That means that all sick and all annual leave will be charged to indirect. You can't like say, well, A&A can pay for theirs, but we'll charge education, the staff, the A&A staff will charge direct, the education staff will charge to indirect. It has to be consistent treatment. You know, it's just like your accountant. If you say that you're going to charge them to the indirect cost pool, and maybe your Ford Foundation grant has some extra money, so you want to pick up some of that accountant's time there, you can't do that because you have said we're going to charge accounting time to indirect. So it has to be consistent. Now, when I'm saying a split, a mixed use, is when you can readily identify that the expense goes for a common purpose of the organization or goes for directly for a program. Does that clarify it for you?
Yes. Okay. So moving on, and I think this question was answered in the chat box, but I'll pose it so everyone can hear it in case they missed it. Can a grant writer be an indirect cost?
Oh, yeah, absolutely. In fact, and Rondell, I apologize. I'm supposed to be talking about that and I totally forgot. Typically, planning departments are part of indirect cost. Okay, because planning departments deal with all projects for the organization. I mean, that's how you build your planning department and your development department and that. So absolutely, yes, that's where you get the money for that stuff. So, and I promised Rondell that I would speak to that, and then I just blew right by it. I'm sorry.
All right, so we have 2 more questions left so far. So the next question is, will there be a training on how to obtain a negotiated indirect cost rate?
We'll throw that one to Rondell.
And here I was sitting back wondering how you were going to address that. At this point in time, everyone, we are not planning a second one. We will go back to A&A and see if they want us to continue on with that. And we will advertise it like we usually do through all of the different listservs that A&A and the regional TA centers have.
Right. Thank you, Rondell.
And let me add on to that. If you have questions about it, because you're thinking about it, you have my contact information.
Awesome. Last question. Can one program have 2 different IDC rates? For instance, if one has a service such as janitorial provided, so is included in the IDC, but the other location is offsite and has to pay directly for theirs, should the offsite location have their own agreement? So it's the same program, 2 locations.
Yeah, okay, you basically need to have a multiple allocation base, which means you need to negotiate a rate. You cannot do that with the de minimis rate, but you can do it with a negotiated rate where you have an on-site and off-site rate. So that would be a negotiated rate, and yes, you can have 2. But don't do it with de minimis, you guys, flat 10%, okay?
That's all the questions I have, Candy.
Great. Well, thank you, everyone, for joining us today. And we will be sending you an email, if you wouldn't mind, please. It will include an evaluation. And again, if you wouldn't mind completing that to let us know how we're doing. We appreciate your time today. We know everyone has busy schedules. And this webinar is being recorded, and it will be available in about 2 weeks on our website and A&A's website. Thank you again for joining us. Stay safe and have a great rest of your day. Thank you.